1,000 euros back in the year 2000 would now only be worth the equivalent of about 700 euros today. The euro has lost over 30% of its purchasing power over the last 20 years, a decline that puts into question the stability of the currency as a store of value and whether this relentless decline in purchasing power is going to persist into the future or, worse yet, become more severe. Inflation in the eurozone hit a record 10.6%. That means the euro's purchasing power was eroding at the fastest rate since the creation of the currency. A currency's strength reflects its economy. It affects the buying power for people using the currency, it impacts local businesses, and the performance of local stock markets. The euro weakened considerably over the last 2 years relative to other major currencies like the US dollar, but also the British pound and the Swiss franc. Let's start by looking at the reasons behind the euro's weakness. This line, for example, represents the return of the euro relative to the British pound, or in other words, the interest rate differential. And this is the exchange rate of the euro relative to the British pound. The relative returns of these currencies and the exchange rate are extremely tightly linked. This line that represents the return on holding a currency is easily calculated. It is the real interest rate of the British pound minus the real interest rate of the euro. The term real just means adjusted for inflation. Central banks, like the Bank of England and the ECB, set the interest rates of the British pound and the euro. This is why central banks have so much power. They can pretty much change their currency's exchange rate by adjusting interest rates. It's the same story between the euro and the US dollar. It's basically a contest between the ECB and the Federal Reserve, the US central bank. This line represents the difference between the real interest rates in the Eurozone and the US. Today, they are at a similar level to where they were in 2005, almost 20 years ago. But there has been many fluctuations, and these fluctuations in the interest rates have been responsible for the fluctuations in the euro to dollar exchange rate. Since 2021, there has been quite a big drop in the euro relative to the dollar. Much of this is due to the changing relative returns between these two currencies that dropped dramatically in 2022. But the major factor behind this move in 2022 was the war in Ukraine. It immediately cut off Europe from Russian gas. This caused energy prices to soar, creating inflation, and it directly slowed the European economy that is heavily dependent on natural gas. This immediately pulled down interest rates in the Eurozone relative to the US, which wasn't directly impacted by the war. We've since seen this reverse as the economic shock from the war has dissipated, but we can now see there's a gap between what interest rate differentials have done and where the euro to dollar exchange rate currently stands. The interest rate differential between the euro and the US dollar is now back at zero, which theoretically means the euro should be trading much higher than current levels. It almost seems like the euro has stayed artificially weak over the last year. Geopolitical uncertainty is a big factor at play here because the war in Ukraine is still going on. Fearing a potential war escalation, investors prefer the safety of the US dollar over the euro. This fear has grown since the conflict started, as Eurozone countries might get involved. This could potentially hurt their economies even more. But war is not the only thing that's pushing investors away from the euro. Declining economic productivity in Europe is another major issue. This chart shows the work productivity of the US, Germany, Italy, and France according to a Harvard study. In the 1970s, Europeans worked about the same number of hours as Americans. But over time, European nations have seen a steeper decline in work productivity than their American counterparts. So when we look at the GDP per capita of the United States, we see it has made quite a spectacular rise since the 1970s. This means the average person in the US has increased their economic output. The Eurozone's GDP per capita has struggled to keep up, on the other hand. We see a clear widening of the gap between American economic output and European economic output. The US is far ahead in key, rapidly growing industries like tech and AI, which is helping fuel this divergence. Europe has lagged behind when it comes to innovation. And when we look at the UK's GDP per capita, we see a similar widening gap, although to a lesser extent than with the US. So in other words, lower productivity in Europe means a lower GDP per capita, which means that the economy struggles to grow. A weaker economy means the ECB needs to keep interest rates lower than the Federal Reserve or the Bank of England, which can lead to a weaker euro. So is there no hope for the euro? Is there nothing that could push its exchange rate higher relative to other currencies? Not entirely. There is something that could push it higher. Currently, both the Bank of England and the US Federal Reserve have higher interest rates than the European Central Bank. This has weakened the euro, as discussed earlier. But there is a possibility that both the UK and the US central banks might cut their interest rates soon. If the UK and US economies slow down and inflation drops to normal levels, the Bank of England and the Fed might lower interest rates to stimulate economic activity. And the reality is that they have more room to lower their rates compared to the ECB. While higher rates have made the USD and GBP strong, if rates go down, they may become less attractive to investors, and money might flow back to the euro. This is a similar situation to the early 2000s and 2006. Back then, The Bank of England and the US Federal Reserve had higher rates than Europe, but they eventually began to cut their rates. In both instances, the euro strengthened as investors rebalanced their portfolios. It could be that a similar situation plays out for the euro today should the Bank of England and Fed cut rates. From a technical standpoint, the long-term structure of the euro to dollar pair suggests that it may have broken down in early 2022 below a long-term price channel. This breakdown could be reflecting the long-term theme of declining productivity in Europe and could mark the beginning of a more prolonged underperformance of the euro relative to the dollar. You'll notice there is also a downwards price channel that defines the trend that the euro has seen since 2008. In order for the technical posture to become better, we need to see the euro come back above this price channel and back into the longer-term uptrend. That would transform this recent breakdown into a false breakdown, which is actually quite a bullish development. The potential for interest rate cuts by the Bank of England and the US Federal Reserve could provide fuel for that type of move. But for the euro to rise considerably relative to the dollar, it needs to begin fixing longer-term issues like its energy dependence and its innovation lag. If you're looking to trade currency pairs like the euro to dollar or dollar to pound, look no further than Capital.com.